Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Alibaba.
And just real quick, if you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10 K with VIP indicators. VIP indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 K is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Awesome, thanks for that. So let's jump right into the hook for today because honestly, this one kind of blew my mind. Imagine seeing a massive publicly traded company, right? And their profits just plummet by like 66% overnight.
Yeah, that's usually a complete disaster.
Exactly. I mean, that is a number that normally triggers absolute fire alarms on Wall Street. You'd expect panic selling, brutal analyst downgrades, just a bloodbath. But with Alibaba right now, we are looking at a situation that just completely breaks the normal rules of financial gravity.
It really does, because you have top institutional analysts looking at that exact same 66% drop, and they're actually calling it one of the most bullish signals of the decade.
Which sounds completely counterintuitive.
It is a phenomenal contradiction. And honestly, it's one of the most fascinating market dynamics playing out right now. It forces you to just look past those terrifying headline numbers and really examine the underlying mechanics. Like, what is that money actually being used for?
Right, right.
All right, let's move into the wealth building context to really understand this. For years, if you heard Alibaba, you probably just immediately thought, oh, the Amazon of China.
Yep, digital retail, cheap consumer goods, massive e-commerce.
Exactly. But what we're unpacking today is how Alibaba is intentionally shedding that legacy retail identity. They are completely transforming into this AI-centric infrastructure powerhouse. And I'm just incredibly curious, how a company manages a pivot of this magnitude without just tearing its own foundation apart.
Well, it's a super delicate operation, but it's also highly aggressive. I mean, for the longest time, the market was penalizing Alibaba. They saw them as just this mature e-commerce giant stuck in a slowing domestic economy.
The growth narrative was basically dead.
Exactly, completely dead. But under the hood, far away from all that consumer spotlight, they have been building an entirely different engine. And what we are seeing recently is that this new engine has finally ignited. Now let's look at the fundamentals, because the tension between those two engines is staggering. I was reading through the Q4 revenue breakdown, and the consolidated revenue growth was just 3% year over year.
Which is tiny.
Yeah, 3% is the definition of a mature coasting business. Growth investors look at that and just yawn.
The numbers totally back that up.
Yeah.
I mean, a 3% growth rate in the core retail business basically signals that the easy days of explosive e-commerce expansion are effectively over. But you have to look at the subsegments.
Right, because while the retail engine is idling, the Cloud Intelligence Group is just going parabolic. The reports show a 38% revenue surge in that division alone. That brings them to over $6 billion.
Yeah.
And what really caught my eye was that their external client revenue was up 40%. So it's not just internal money moving around. Outside businesses are actively flocking to them.
And here is the critical distinction that all these analysts are obsessing over right now. Their AI-related product revenue has hit triple-digit percentage growth for 11 consecutive quarters.
Wow. 11 quarters.
11 quarters. Over 100% growth each time. That's not some, temporary pandemic-era spike. It indicates a massive structural shift in how businesses across Asia are consuming computing power. It completely validates their management's thesis that AI monetization isn't some abstract future promise. It's happening natively on their servers today.
And management is clearly leaning into this. They've laid out this incredibly bold target, right? They want to surpass $100 billion in combined cloud and AI external revenue over the next 5 years.
It's massive.
Yeah, and the mechanism they're using to get there is this thing called Model as a Service, or MaaS. How does that actually work? Because it sounds really different from just renting out regular server space.
Oh, it's entirely different. Historically, cloud computing was basically just infrastructure as a service. You rented raw server space, which, let's be honest, ultimately just becomes a commodity race to the bottom on pricing.
Right, whoever's cheapest wins.
Yeah. Exactly. But with model as a service, Alibaba isn't just providing the storage. They're providing the actual AI brain, their Quinn models like utility.
Yeah.
So companies don't have to spend billions building an AI from scratch. They just plug their own proprietary data right into Alibaba's pre-built infrastructure.
You know, it totally reminds me of Amazon's historical pivot to AWS. Amazon basically used their super low margin retail storefront to fund the creation of this massive digital backend. And that eventually became the real profit engine. It feels like Alibaba is doing the exact same thing, positioning themselves as the digital landlord of Asia's AI future.
That analogy holds up perfectly, especially when you factor in data gravity.
Data gravity.
Yeah, so when an enterprise client trains an AI agent using Alibaba's system, their highly sensitive proprietary data becomes deeply interwoven with that Quinn model. If that company suddenly decides, hey, we want to move to a different cloud provider, they can't just copy and paste that perfectly tuned AI.
Oh, I see. They'd have to start all over again.
Exactly. The switching costs are astronomical. Once Alibaba gets a client onto their platform, they are essentially locked in for good.
Okay, so they have this sticky revenue model. The cloud division is growing at 38%. You'd think they'd be swimming in profits. But looking at the bottom line, it looks like an absolute bloodbath. I mean, non-GAAP net income dropped 66% year over year. Adjusted EBITDA fell 57%, and free cash flow turned negative to the tune of $2.5 billion last quarter. If I'm managing my own portfolio, a negative $2.5 billion cash flow sounds terrifying.
Under normal circumstances, it definitely would be. But this is what we call a productive loss. You have to track where that capital is actually flowing. It isn't vanishing into operational bloat. They are ruthlessly redeploying it. Over 90% of their March quarter China e-commerce profit was taken directly from retail and pumped straight into user acquisition for their AI models.
So they are intentionally starving the legacy retail business to feed the AI ecosystem.
Exactly. It's a period of intense strategic margin compression.
But wait, hold on. They've publicly committed to a $53 billion AI investment plan through 2027. If your free cash flow is negative $2.5 billion for the quarter, how do you internally fund $53 billion? Are they just taking on massive high-interest debt? Because that seems crazy risky.
And that right there is the secret weapon that most casual observers completely miss. Alibaba doesn't need to beg investment banks for loans. As of December 2025, they're sitting on a massive fortress of $42.5 billion in unencumbered net cash.
Wait, $42.5 billion in cash, just sitting there?
Just sitting there. They are essentially acting as their own central bank. They can entirely bypass the credit markets. They can fund this entire AI rollout internally and take the massive hit to their profitability today just to own the infrastructure of tomorrow.
And to keep Wall Street from completely revolting while profits are down, they're doing an aggressive share buyback, right? I saw the yield's nearing 5%.
Right. The buyback artificially reduces the share count, which provides a floor for the stock price and props up their earnings per share metric. It's brilliant financial engineering just to buy themselves the time they need.
Wow. All right, that brings us to the catalyst timeline. Because having cash is great, but what are the catalysts that are actually going to drive this forward? We talked about that $100 billion revenue target. Bet there's also a geopolitical angle here, right?
Yeah, the geopolitical thaw is a massive catalyst. For the longest time, the risk premium attached to any Chinese tech stock was huge because of U.S.-China trade tensions. But recently, NVIDIA was granted clearance to sell H200 chips to China. And we've seen diplomatic engagements like the Trump-Xi meetings that really signal a desire to keep the tech supply chain from completely fracturing.
Which takes a lot of the anxiety out of the stock. But what about their own chips? Because I read about this proprietary T-head chip division.
Oh, the T-head division is their ultimate geopolitical shield. They aren't just relying on NVIDIA. Alibaba has already shipped 470,000 of their own AI chips, generating about 10 billion RMB annually. They control the physical hardware and the software, which makes running their AI dramatically cheaper than competitors.
And speaking of catalysts, I keep seeing these unconfirmed rumors about electric vehicle partnerships, like major tie-ups with BYD, BMW, XPeng, plus whispers they might spin off that T-head chip division. How seriously should we take that?
I mean, they are speculative, but structurally, it makes total sense. Modern EVs are basically rolling data centers. They need massive compute power for autonomous driving. If Alibaba embeds its cloud and AI natively into Asian EVs, that opens up a market that totally dwarfs standard enterprise cloud computing. And a T-head spinoff would unlock billions in value.
Now let's pivot to the chart, because the technicals here are wild. Looking at the market psychology, the stock is trading at roughly a 28% discount to its 52-week high of $192.67.
Yeah, the market has really struggled to price this long-term AI vision over short-term profit misses.
And that Q4 earnings release was the perfect example of this slingshot price action. The automated trading algorithm scanned the headline, saw net income down 66%, and instantly dumped the stock. It gapped down 2% in the pre-market.
Pure algorithmic panic.
Right. But then human analysts actually read the report. They saw the 38% cloud growth, the AI expansion, and realized the loss was a strategic choice. So human conviction stepped in, violently reversed the trend, and the stock surged 8% to close at $145.81.
Exactly. It completely erased the pre-market losses on huge volume.
So what does market sentiment look like going forward? Because it feels like a major momentum shift.
It really is.
Mm.
Earlier this year, major hedge funds were capitulating. Kingstone Capital, for instance, liquidated 9 million shares. They thought it was value trap. But that post-earnings surge shows that all those liquidated shares have been absorbed by smart money.
They're stepping in for that 5% buyback yield
Yeah.
and the AI upside.
Right. And you're seeing massive analyst upgrades. JP Morgan raised their price target to $205, Barclays to $195, Mizuho to $195. Institutional analysts are literally calling Alibaba a Microsoft, Amazon, NVIDIA mashup.
A Microsoft, Amazon, NVIDIA mashup. That is an incredible rebranding from uninvestable geopolitical risk.
It really is a totally different narrative now.
Now let's talk about the risks. Because to be fair, there is a bear case here, and we need to look at the existential threats. The biggest one seems to be CapEx duration risk.
Yeah, that's the danger that these heavy AI investments take way longer to become profitable than management hopes.
Right, like what if cloud growth drops back down to 20% before their margins recover? Then this productive investment just becomes a cash burn nightmare. Plus, they're funding this whole $53 billion plan using profits from their retail business. But that retail business is under fierce attack from domestic rivals like PDD and JD.
Exactly. PD and JD are aggressively eroding Alibaba's foundational profits. If that legacy retail engine bleeds out faster than the AI engine matures, the whole funding pipeline could collapse.
And the geopolitical risks haven't totally vanished, right? There is that recent U.S. chip smuggling probe just days before the earnings report.
Right, which is a stark reminder that export controls are still a constant operational headache. But, the counterpoint to all that bearishness is that $42.5 billion cash hoard. Even if e-commerce bleeds out faster than expected, they have the reserves to bridge a very, very long gap. And a lot of that fear is already baked into that 28% discount on the stock price.
So with everything on the table, what's the final verdict?
When you weigh the underlying fundamentals against those operational risks, the aggregate institutional analysis delivers an 8 out of 10 bullish score.
Okay, 8 out of 10.
Yeah. The core thesis is that Alibaba is currently mispriced by the broader market because algorithms and casual investors are just misinterpreting deliberate margin compression as a fundamental decay. They are willingly taking the hit today to own the infrastructure of tomorrow. So looking at a 12 to 24-month horizon, it offers massive potential as this AI CapEx cycle matures into sustained cloud revenue. It's a highly compelling setup for anyone with a multi-year, long-term view.
And this is exactly why understanding the mechanics behind the headlines is so important for you as a listener. Alibaba is the perfect case study of a market that struggles to price long-term vision over short-term quarterly profits. Sometimes, intentionally taking a 66% profit drop is exactly the radical surgery you need to slingshot forward and dominate the next decade.
I completely agree.
I mean, if they really succeed in embedding their AI into the Asian electric vehicle market, do they basically evolve from an internet company into the digital operating system for the physical world?
Now that is a question that completely redefines their total value.
Definitely something for you to ponder. And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $100 to $10 to $10 Ks with VIP indicators. And their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.